Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
On the show today, we've got three major stories for you. We'll start in the Middle East, where the UAE and Saudi Arabia are pouring billions into AI with partners like Nvidia and Microsoft. But is this just creating a new kind of dependency on the US? Then we'll unpack that blockbuster 3.0% US GDP growth number. It's hiding a secret that has the Federal Reserve watching closely. And finally, a massive comeback story, how Figma turned a failed $20 billion merger into a triumphant IPO that has Wall Street buzzing. Forget black gold. The new mantra echoing from the Gulf is this: compute is the new oil. That's the exact quote from one analyst, and it captures a massive economic earthquake. But that metaphor is a bit tricky. Unlike oil, which is a finite resource you extract from your own land and sell, compute is a service built on rapidly evolving foreign technology. This strategy actually risks creating a new, more fragile form of technological dependency on the US rather than true economic sovereignty. Nations built on fossil fuels like the UAE and Saudi Arabia are now in a high-stakes race to become global AI superpowers. The new currency isn't barrels, it's processing power. At the heart of this ambition is a project codenamed Stargate, a multi-billion-dollar data center cluster in Abu Dhabi, so vast it's being called the largest AI infrastructure hub outside the United States. It's being bankrolled by the Emirati state-linked firm G42, with US tech giants Nvidia, Cisco, and Oracle all piling in to build it. And the numbers are staggering. But building on this scale, especially in the Gulf, comes with a hidden cost that isn't measured in dollars. Here's where it gets interesting. These massive data centers are incredibly energy and water intensive. In one of the hottest and most water scarce regions on Earth, a single data center can consume millions of liters of water every single day just for cooling. While the region is investing heavily in solar and even nuclear power to meet the energy demand, the sheer environmental strain of this AI ambition is a monumental challenge. The UAE state investment firm Mubadala is backing a $100 billion AI-focused joint venture with Microsoft. Not to be outdone, Saudi Arabia's public investment fund is launching its own AI factories, with plans to acquire several 100,000 of Nvidia's most advanced chips. But this isn't just about building a post-oil future. It's about choosing a side in the escalating tech rivalry between the US and China. A recent US strategic pivot saw Washington ease restrictions on exporting its most powerful chips to the Gulf. As one expert put it, this is about bringing the region into the American AI stack, to be on Team America AI. In return, the UAE has already begun scaling back projects with Chinese tech giant Huawei. The choice seems clear, with one insider noting the Americans are simply ahead in the AI game right now. But that's not the whole picture. The real turning point is that even as they align with the US, the core technology, the chips from Nvidia, the cloud platforms from Microsoft is all American. This raises a critical question about their long-term plan. Are they on a path to developing genuine sovereign AI capabilities, or are they at risk of simply becoming the world's most advanced digital landlords for US tech giants? Another analyst warns not to underestimate China, pointing out that their AI stack may not be as powerful, but it's cheaper. And for many countries, good enough is good enough. The battle for the world's new oil has only just begun. Speaking of high-stakes economic moves, the latest numbers out of the US are painting a very confusing picture. The economy just posted a blockbuster 3.0% growth number, smashing expectations and reversing last quarter's contraction. But don't pop the champagne just yet. That headline figure is hiding a dangerous secret. It turns out the economy didn't get stronger. It was propped up by a statistical illusion. Imports into the United States didn't just slow down, they plummeted at a record 30.3% rate. This massive drop in foreign goods artificially added nearly 5 full percentage points to the GDP calculation. So the thing is, this isn't random. We're seeing something called the bullwhip effect in action, amplified by unpredictable trade policy. Think about it. When companies heard whispers of new tariffs, they rushed to import as many goods as they could before the taxes hit. This created a massive temporary surge in imports. But once their warehouses were full, they slammed on the brakes. That's why we see this record collapse. Modern supply chains, which are built for efficiency, are actually very vulnerable to these kinds of shocks. And the ripple effect is what you're seeing in this GDP number. If you peel back that layer of volatile trade data, however, a much darker picture emerges. The true measure of domestic demand, what businesses and consumers are actually buying, grew at a crawl of only 1.2%. That's the slowest pace in over 2 years. This is where the situation takes a more complex turn. It creates a battle of competing narratives. Political actors can point to that big 3.0% headline GDP number and paint a picture of a booming economy. But institutions like the Federal Reserve are looking at the much weaker domestic demand numbers to make their decisions. They are looking at the same economy, but drawing vastly different conclusions. And this selective use of data can make it incredibly difficult for the public to understand what's actually going on. Consumer spending, the engine of the entire economy, is sputtering, rising at a meager 1.4%. Business investment in new equipment has slowed dramatically. And one chief economist at TS Lombard didn't mince words, calling the situation, quote, not pretty, an own goal by US policymakers. The Federal Reserve is clearly paying attention, acknowledging that uncertainty about the economic outlook remains elevated while resisting pressure to slash interest rates. This all begs the question, if the headline number is a mirage, how weak is the foundation it's built on? And interestingly enough, this whole situation highlights a much bigger problem. Gross domestic product, or GDP, is often a flawed way to measure a country's actual well-being. It was designed for a different era. Today, it struggles to account for the value of digital services, and it famously ignores things like environmental damage or income inequality. In fact, some economists are pushing for alternative metrics, like the Genuine Progress Indicator, which adjusts GDP by subtracting the costs of pollution and adding the value of things like volunteer work to get a more honest picture of our economic health. The data shows an economy that has weakened considerably, leaving investors to wonder if the engine is about to stall. From a shaky economic outlook to a story of defiant success, a $20 billion blockbuster deal for software firm Figma gets killed by regulators. Most companies would stumble. Figma? They just answered back by raising over $1.2 billion in a massive initial public offering. Now, get this. That failed Adobe deal, blocked over antitrust concerns, wasn't a setback, it was a catalyst. It forced Figma to double down on its own strategy. And did they ever? In the first quarter of 2025 alone, Figma's revenue surged 46% and its net income tripled to nearly $45 million. They didn't just survive, they thrived, becoming a stronger, more focused public competitor. The deal didn't just succeed, it shattered expectations. Figma sold its shares for $33 a piece, blowing past its already increased target range and signaling ferocious investor demand. The IPO now values the company at nearly $19.34 billion. That number is critical. It's just shy of the $20 billion Adobe was forced to walk away from. The reason investors are so excited isn't just about a comeback story. They are betting on staggering growth metrics. We're talking about a 46% year-over-year revenue increase and incredible 88% gross margins. But the killer stat that has everyone talking is a 132% net dollar retention rate. That means their existing customers aren't just staying, they're spending 32% more on average each year. It's a textbook example of a perfect land and expand business model. This isn't just a comeback story, it's a potential turning point for the entire tech sector. After a years-long freeze in US capital markets, Figma's IPO is being seen as the ultimate litmus test for investor confidence. The market has been starved for high-growth tech listings, with many top-tier companies sitting on the sidelines since early 2022. However, if you zoom out, you'll see another layer of strategy at play. Figma's success is also tied to its heavy investment in artificial intelligence. They're not using AI to replace designers. Instead, they're building tools to augment them, automating repetitive tasks so designers can focus on high-level creative work. This focus on AI as a collaborative partner is exactly what investors are looking for right now. Analysts are already stating that Figma's public outperformance will likely fuel the IPO appetite for other disruptive tech unicorns like Stripe and Databricks for the rest of the year. The core conflict here is bigger than Figma versus Adobe. It's about a new wave of tech companies testing public market demand, betting that the long winter for IPOs is finally over. So is this the single event that breaks the logjam? After Figma's defiant debut on the New York Stock Exchange, Wall Street is betting the floodgates are about to open. As with any new stock listing, market conditions are volatile and subject to change. This report is for informational purposes and is not investment advice.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.